Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Thursday edition of Benzinga's PreMarket Prep. I'm Spencer Israel, as always, joined by Joel Elconin and Dennis Dick. Got another busy show for you. The markets aren't sleeping for us today. We're talking a lot of ratings. We got some earnings to discuss as well. A lot of movement in yesterday's markets. So we're going to talk about as much of it as we can. We have the Fed, of course, gold catching a bit, Alibaba, Alcoa, dry ships, VRX. So a lot to get to. Walmart had earnings and a few other big earnings as well. L Brand, Cisco, we'll get to all of that. And take your questions from the chat. As always, our guest today will be at 8:35. That's Jeremy Schwartz. He's the Director of Research at Wisdom Tree. Joel, how's it going in the markets?
Not very good, Spencer. The S&Ps are in the red by 5 1/4. Found resistance just above the close, 68.50 pre-market.
Joel, you okay?
Okay there.
Did you just die?
I did not die.
Okay.
Just got a little cough here.
I think we lost Joel. Get the paddles out.
Pre-market low, 60 1/4. Now, that's a big number because Tuesday's low was 60 1/4 as well. Crude in the red by 14 cents. Gold and silver both caught bids right before the Fed minutes yesterday. Gold up $8.50 at $12.91.30, and silver in the green by 14 cents, back over $17. Dennis, a little pressure on the European banks. What else are you seeing in the markets this morning?
Well, so seeing weakness across the board, really. The only thing looking strong here are the metals again. We got gold and silver, like you were saying yesterday, after the Fed minutes catching a bid there. The rally continues here this morning in gold as well, as GLD trading up 36 cents. Silver also trading a little bit in the green, not nearly as much. It's only up a penny here now. But that's the only thing you're really seeing rally besides Alibaba, which is just a moonshot here. And maybe that's where we should start, because Alibaba, you're kicking yourself a little bit. I'm kicking myself a little bit. We're all kicking ourselves a little bit, because this is a stock that, out of all the momos, we've been bullish on this show ever since that earnings report last time when they blew it away. Actually, it wasn't earnings. It was guidance last time. So they guided way higher back there in June. That was the gap and go. And here it is. Here's the quarter, and it's not surprising they blew it away.
Yeah, $1.17 versus 93-cent EPS estimate. Sales of $7.4 billion versus $7.13 billion. So good beat on the top and good beat on the bottom. Annual active consumers, 466 million. Mobile monthly active users, 529 million, up 22 million month over month. So they're killing it on on mobile, but they're killing it everywhere. So.
Just a monster. I mean, this stock has been, it's closed near its all-time high now, obviously making new all-time highs here again. I don't know, trend's your friend here. How do you fight this one? I mean, it bumped up against that 160 a few times. Now you got the massive breakout here on the earnings report. Joel, break this down for us.
There's not much to tell you, Dennis. You could just look at the pre-market high, just under 172, 171.89. That's your pre-market high. We're $3 off off that high. So I would just use half and whole numbers. I can't think of getting long anywhere up here. Not necessarily trying to short either, but if I was long, trying to get out of some stock, man, I'd have my offers there at 169, 170, 171, and then a boatload at 172, because that's just above the pre-market high. But they told us last quarter that they were going to be making more money, that their revenues were going up. And, it just never got the gap fill that you wanted. We're looking at the daily charts here after that last report. Left a huge gap. And now, I mean, it's tough. I'm not going to chase it up here. But that's one. I mean, it's not easy to, follow the companies and everything and get their predictions. But on this one, they certainly tried to warn us.
Yeah, and they were correct. And here's the blowaway for the earnings. If you're bored and you don't like trading the BABA, you can always trade the AABA, the Alt BABA, or Alt-Taba or whatever they call it. I think they should call it Alt-Baba, not Alt-Taba. But AABA obviously tracks the stock. That's the Yahoo spinoff there, and it's trading up 4.5% as well. I mean, the technicals are going to be the same, as just a different number, but these trade almost percent for percent. So you've got Baba. Actually, AABA closed a little bit stronger, so it's not surprising that AABA isn't up quite as much as the Baba here this morning, but it's up 4.5%, and it will follow Alibaba.
I'll just give you your pre-market high in the alternative Baba, 64.50. And then Yahoo, let's see here. I'm going to still call it Yahoo. We are back at levels.
Yahoo's gone. Yahoo is Alt-Baba.
We haven't been in the 60 handle since September of 2000. So if you've been holding on since then, here's your chance to sell.
So you're looking at that Alt-Taba chart and saying that's the old Yahoo, and you're looking at a level. When were we up here? It's the 60s.
Is it okay if I do that, Dennis? Do I need?
They had me confused. I was like, "What do you mean? There is no Yahoo. What is this Yahoo you speak of?"
Okay, Chemo.
You can call it Yahoo. I mean, you want to call it AABA, you could call it Yahoo, I guess. Well, parts went to Verizon.
Well,
so we're literally left with just a tracking stock for Alibaba. So it's, you could call it Yahoo if you want, but I'm calling it Alt-Baba. That's what I call this, AABA.
We were back up in here in September of 2000.
Walmart, WMT earnings, and kicking myself on this one too. My butt is really starting to hurt because I keep kicking it. Okay, here's the run up, and we were talking yesterday, and we've been talking on the show. Major resistance up here around 82. There was some size up at 81.50 even. Not surprising. That's where it tops out in the pre-market here. And the report comes out, and the guidance disappoints. Spencer, give us the results.
Yeah, well, the Q2 earnings were okay. They beat EPS by a penny, $1.08 versus $1.07. Sales of 123.4 versus $122.8 billion. So they just barely beat on the Q2 earnings and sales, but like you said, Dennis, the guidance was bad. Q3 EPS guidance, 90 to 98 cents is what they guided. 98 cents was the estimate, so they're coming in at the low end of that. The fiscal year EPS coming in pretty low as well, so not looking great. They did say the Q2 U.S. comps are up about 2%, and net e-commerce sales were up 60%, so that's a good sign, but you guide bad on the quarter, and that'll happen.
And it's run up, and it was one of the retailers that were holding on to their highs. A lot of these retailers are significantly off the highs. I mean, Target kind of had a great report, and they gave it all back. Like, that Target action yesterday was incredible. I mean, when you look at the stock, opened up at 57, half an hour later, it traded flat. It came all the way back down to basically where it closed, and then rallied all the way back up again. So wild trading action in Target. Walmart was kind of getting whipsawed with it a little bit as well. Walmart opened high and then obviously gave it all back too, and actually was trading in the red. It got bid up last night, got bid up a little bit ahead of the report, but the guidance is no good, and that's why it's selling off.
You did have a triple bottom at the 80.50 level. Don't know if that's going to come into play today. So longer term, if you're looking for a bounce, I actually see 1, 2, 3, 4, 5 lows in that area. So longer term, maybe trying to wiggle out at 80. Shorter term, I'll give you the pre-market low. The pre-market low is 78.50. But look at the daily chart on this one, Dennis, and you tell me if you want to be long this thing below $80.
No, I don't. No.
I mean, look at that. From 76 to 80. Yeah, there's some daily lows in there. Yeah, there's some daily closes in there. But I don't like the price action there, and not running out.
I wanted to be long back when the stock was at $58 back in 2015, and I was greedy again. I wanted to get down to 50, and it never got there.
I know we're having some crazy weather this morning. Joel, did you?
Joel, I don't know. Joel's got problems. He's got hiccups, and now I think a hurricane got him.
Yeah.
So.
Is it
Joel?
the
You're alive still? This is the second time we're checking your status on life.
He's still with us. All right. What? Or actually, do we?
Well, other earnings here.
Yeah.
Let's go to Cisco last night. We got some major reports. Baba's, Walmart. So Cisco's a big one here too. And of course, Cisco is third on our list. CSCO reported last night, and they disappointed. Spencer?
Yes, they did. CSCO report Q4 adjusted EPS 61 cents is in line with the estimate. Sales of 12.1 versus 12.07 billion. So not a bad Q4, but the Q1 guidance 59 cents to 61 cents is the EPS. That's right in line. Sales though down 1 to 3% year over year, and so that'll do it.
And stock whipsawed a little bit on this report, and then they eventually started settling down and ended up trading down. And now we're down here at 31.5. I like the 31 level, Joel. We're just kind of a ways away from that, though.
Yeah, battled back after the last report. Once again, look at the daily charts here. Just a big run up all the way from 31 up to 32.5 before the report. Finding some buyers here in the pre-market session at 31.25. That's your pre-market low. So yeah, I'd say maybe see 31 down 71 cents today, but looks like you got some people that were perhaps short ahead of the report, bringing some stuff in at 31.25. A great target would be 31 even. Two lows at 31.04 and 31 even, right on the nose, but a little stubborn right now.
And then the last big one from last night, L Brands, and this is an absolute disaster. Once again, I mean, LB, talk about a fall from grace. Go out to your weeklies. At the beginning of 2016, this stock was over $100. Actually, at the end of 2016 or 2015, and then beginning of 2016 was 95. It's now $36. You're talking about a stock that's fallen almost 70% from the highs here. This is a big fall for LB. Once again, Spencer, give us the details.
I guess millennials just aren't shopping at Victoria's Secrets.
Do they not wear lingerie anymore?
I don't
millennials?
Know.
Is that what it is?
They're killing.
Well, they don't go out.
They're killing. They're killing everything, Dennis. They're killing everything. Here's the report.
It's just Amazon. Can you buy lingerie on Amazon?
Of course, you can buy anything. The only thing you can't buy is stuff from Home Depot.
This is not good for Victoria's Secrets when you can buy lingerie on Amazon.
All right, LB adjusted EPS 48 cents versus a 44-cent estimate. Sales of 2.755 versus $2.75 billion estimate. So they pretty okay on the on the Q2. Their comps, however, were down 8%, and they're cutting their outlook for the fiscal year and for the quarter. EPS is cut for both.
I don't know what to say here. This is one you look and you think, I was saying even yesterday, I'm going to start, combing through all these retailers because there's going to be some value in here somewhere. And you look at this and you think, yeah, maybe there's some value here. And then you think, I don't know, Victoria's Secrets, you start analyzing. You just wonder, I'm not going to start buying these stocks until these stocks.
I'm not buying any of them. I'm not buying.
I'm just buying Amazon and forgetting about everything else. Eventually, we will just have Amazon. Remember that Simpsons episode? And this is, kind of like the way the retailers are now, where they had the mall, and Homer Simpson was going through the mall, and he's like at the one shop in the mall. He's like, you've got to, leave the store soon because we're turning this into a Starbucks. Then Homer Simpson steps out of the mall. He starts walking down the mall, and every single store in the mall is a Starbucks. It's kind of how I feel with Amazon. Every single thing we see now is going to be Amazon. Maybe once they start the Amazon stores, maybe that's going to be it. We'll just have to do everything at Amazon. We'll buy our cars at Amazon. We're going to buy, our, if we go on a trip, it won't be Priceline. You'll go to Amazon, to buy your vacation. If you want to buy your food, it's obviously going to be at Amazon with the new Whole Food stores. I mean, it's going to be Amazon.
And
everything Amazon.
Especially
Starbucks out of business too because they'll be selling coffee. It'll be Amazon. Amazon coffee shops.
No, but especially with clothes.
I call them amazing.
With clothes like this that you have to try on it. So now that you can just order something, get it shipped to you. If you don't like it, you put it back in the box and you send it back. It's it's the easiest thing ever. So even if you don't like it, it takes 5 minutes of your time to try on and send it back. And it's just so convenient. So yeah, I don't know. It's just not shopping at Victoria's Secret, I guess.
So scared of retailers. I own pretty much none of my investment portfolio, and I want to put some in there. Everything says to me as a value guy, there's so much value here. I want to jump into these, and I just can't find one that I'm not scared of Amazon on.
Just think if you would have, every time you said you're going to look for a buy in a retailer, if you would have bought 20 shares or 25 shares of Amazon.
Well, I've only been saying that for a week, so.
Oh, really?
Would I be up money already?
Let's do the price act. Nah, it's pulled off.
Actually, it would be. It was at $9.50.
Let's
already
do
a 1 week strategy.
Let's get to the price action.
Talk to me about LB.
All right.
Find me some levels. Find me a level.
35.45. That was your after hours low. All right. So you need to go back to July of 2012. You had the low at 35.46, 35.5 potential support level. And the only reason I don't think it's going to get there is because you bounced off it, right? Pretty hard. You're holding in here at almost at $37. So I think you're going to see, if we come back down here, I think you're going to find buyers ahead of the pre-market low. The rebound off the high, 37.69. So there's your range in L brands from 36 change to 37.69.
While we're talking the retailers here, have you seen the chart of RH as of late? I mean, a month ago we were saying, what is going on here? Why does RH just keep rallying? Dillard's too. Why does it keep going straight up? And we already yelled at Dillard's, and and actually we were talking about Dillard's, and then everybody's tweeting at me, oh, it's easy to say after the fact. I mean, we were saying this before the fact if they listen to the pre-market show, that I didn't understand the run up in either of these stocks. Didn't short them, but wow. It's a fall from grace here now. So RH got up to $79.91 when everybody thought it was taking over the world, and now it's back down here $51. So now does it get interesting for you down here, Joel? Now that we've given back the entire rally pretty much from June and July, or are you hands off on this? And is this going to get Amazon too?
Oh no, I'm still interested in shorting it. For sure. I don't know. I've played this one. I watched that run, and I just. Man, you got to figure out a way, with the candles here. I'm looking at the dailies, and I'm looking at the breakdown. You had an old double bottom at 72.50. Actually, it was a triple bottom, and then it took that out, and then it was SIA. I mean, I know they're reporting soon. I don't know if they're getting hit on this at all, but man, this whole thing emanated from a 41.52 low on that disastrous report. So, I mean, Dennis, you and I have been making fun of the stuff that they sell in there for years. So I don't know.
We've been wrong on this for a long time. So me and Joel started getting bearish, I think around 35. I went up to 80. It's 51. We're getting all cocky here.
Yeah. We know what you're talking about.
At 80, we were like, we got this one dead wrong.
I don't understand it.
I don't understand the trading action, why this thing's so wild. I know, like on Dillard's, they were saying it's a real estate play. I've argued before, okay, yeah, sure, if they've got some real estate, but is that real estate worth as much as it used to be when everything's going online? Physical real estate, for commercial stores, just I don't think it's going to be worth as much as it was before, unless they find another use for it. And I have heard, that they're trying. Was it you, Spencer, that was telling me that, they're turning like mall spaces into like churches and stuff, and
that was not me.
No, was that you?
That was not. That was not me. Office space, maybe not, but I don't think. I think that was Joel.
It was me. It was me. Mark did an article on it. But before we move on to our next thing, I just want to point out a really good level in the S&Ps here, and that level is right where the low is at 24.60 and a quarter. Your low on Tuesday was 24.60, Dennis, and I'm going to give you one guess, and only one guess. Looking over the last few weeks of price action, why is 24.60 significant?
Give me the SPY equivalent, because I don't like futures quotes. You know how I am, and they want to charge me $600 a month for the ES quotes. I just use the SPY. So that's what you get when you want to charge too much money to all the pros. That's what happens. $600. Well, I pay zero now for my S&P futures quotes because I just use the SPY. Okay, give me the SPY equivalent.
Okay, the SPY equivalent.
Must be 244.
SPY equivalent, the all-time high, 248.91. The low of that move, 243.70.
So, and you're saying that 243.70, you're like in that level if it gets back down there, or are you looking the 50%?
Exactly. And it was
all of the above.
Yep, it was a 5-point move, approximately, right? So add 2.5, 44.70, 45.70, 46 and a quarter. Look at Tuesday's low, 46.16. So both are just hanging on the 50%. I'm going to go out on a line here. We take out 24.60. I think we're going to have a pretty good down day, and we're just hanging there right now. So it got through the 50% retracement. Now it's coming back to consolidated 24.60. Not only is that my number of the day, but it's been my number of the week. So keeping an eye on 24.60 even.
European banks, Deutsche Bank getting crushed here this morning. Again, I was trying to find what the headline is on this thing. It's down 3% here now at 1653. Looking at the other ones, they're down. They're all down over there, but not down nearly as much as DB. DB getting crushed. And just quietly here, DB has been a major fall from grace as well. I know there's some currency issues that are probably involved in this as well, But, if we're just taking the chart straight up, that 20 was major resistance. You're coming back into support, which was down at 16. So, if we're just looking at the U.S. chart here, you're kind of just in the same range, but you're back at the bottom of the range here. Talk about DB.
Deutsche Bank, that $20 area has been an area of resistance going all the way back to late 2015. The lows of the move here, we have taken out that July low. I'll go out a little bit farther out and look at 1567. That's still another stick away. But remember, this is an ADR. You're not trading the primary market. But, things shift around, Dennis, right? Different things for the market to worry about. North Korea, U.S. politics, and now, China. And now concerned over, I'm not seeing exactly what the news is, but European banks going down, not a good thing.
No, and this is one more thing to worry about here. Our banks are starting to leak a little bit here. We know they often do move with the European bank. I'm not really seeing like a sector that's leading the charge down here today, though. Like a lot of times you're like, okay, well, that's the reason we're following here. We can see this stock really getting hit. It's kind of just a little bit of slight weakness across the board. I know Walmart's weaker, so, the retailers might be down just slightly, but, we've already had a lot of retailers reports. I don't know how much that's going to spill over into the other retailers or not. Alibaba's trying to push the market up, but it just can't do it. It's kind of just seeing across the board weakness here. So it's no jump out here. Just even when I'm looking, it's going to be curious in 8 minutes when I see the imbalances to see if we see anything else that's, really leading the charge down here. But as of right now, it's just kind of leaking. It's a slow leak in the S&P futures this morning.
2460 and a quarter, folks. Just banging on the door of that 2460 even prints. So hanging on a big level. We'll see what happens.
Okay, a couple other stocks here I want to talk about. And the steel stocks were moving yesterday. This has been a massive consolidation, that U.S. steel. We got killed. We know on the earnings report it got and breached 20, and then it's bound underneath demand. Every time this thing pulls back a little bit, it just seems to find more buyers. U.S. steel here traded up yesterday. Yeah, U.S. steel was up again yesterday.
58 and a half, Dennis. We got some problems here in SPU land.
What's going on in SPU land?
50. We just dropped 2 points. We took out that 2460 level, made a 58 and a half print.
Got some nervous Nellies out here.
Yeah.
Is Trump tweeting again?
Oh, I don't even have. Do you have?
I don't think so. I haven't seen anything. But
all right,
but let me look.
Let me somebody on the Trump Twitter.
Since you brought it up, let me look.
Let me know. Just break in if Trump says something.
I'll break in.
Spencer's on it. He's opened up the Trump page. I don't have enough screen room here to have Trump on there. He hasn't moved the market enough for me to give him an allocated screen room here yet. Anyway, so I was talking U.S. Steel had a nice move up yesterday. Also, the other metals, Alcoa was up big yesterday. If you like the 2-day move, you think maybe on pullbacks, maybe these things, but with the weakness in the S&Ps, I'm just not sure we're going to get a 2-day move in a lot of these stocks there. But metals, the steel and the aluminum stocks were moving up yesterday.
Wasn't there a little chatter on infrastructure talk yesterday?
Is that what it was?
Yeah, I think it was. Don't quote me on it, but I do believe,
building the wall again?
Yeah. And you know what? Mexico's paying for it. But I don't know. I've always been leery of the U.S. Steel, just inconsistent earnings reports. Hit a nice resistance level yesterday. I'd say $25. We backed off that 24.95 high. Couple other highs in that area. So maybe if it gets back down to that 20 area again, but right now easier to find this $25 resistance level. And didn't Nucor get like a downgrade today? Or am I
believe it did. No, Nucor got downgraded to KeyBank today.
Yeah, so I think that might negate the 2-day rule for the rally here. But that's not
what? If Nucor could get down, check out the Nucor chart though. What do you think of that 55.30? I like that. If this really spilled down, and I don't know if it's going to go down that low, but there's a triple bottom right down there, 55.30. Could we get down there to that area again today? If we did, I think it's support down there. I just don't know if it gets that far down on the day.
You also had a low in that area at 55.18 on June 20th. So there's a good level for you in Nucor. That's a pretty thin one, isn't it, Dennis?
No, Nucor is kind of thick. NUE, that's the one steel stock that I think is best of breed. I've had Nucor in my portfolio for a decade. It's really gone nowhere. It's paid me a little dividend the whole time, but this is, I believe, one of the better steel stocks. It's also not nearly as volatile as a U.S. Steel. So if you want a little more stable one, it's Nucor. But if you're going after return, X has a a lot higher beta than NUE does.
Oh, we joke around a lot, Dennis, when different things come out. But if you looked at the chart of ADP,
What happened there? What was the reason that thing took off?
Ackman bought it.
No, yeah.
Was that when Ackman bought it?
Yep.
Yes. Isn't it, Spencer?
They bought. I think you're right. I do remember that. We were joking. 15 points because Ackman got in. It gives it all back. Shocker. Fade Ackman trade works again. Shocker.
I know. I think we tweeted
How's
that out.
Doing Ackman?
320.
He's in a 420 or 430, so he's not down 100 points in that one too.
317.41. 317.41. That's the low of the move. And we made that 2 days ago. Looks like we might hit it today with a weak market.
It's hanging here again. I'm going to tell you on CMG when I'm looking at this thing, 317, 319. We breached that 317.41. We're going under 300. I keep saying, I should say it every day on the show. I've said it for like the last
short it.
We were starting at 350. I was saying it's going under 300. It's 320. I still say it's going under 300. And I still think they're going to warn this quarter. When they warn, we're going to have to write an article because I've been saying this for every day on the show. I'm going to continue to say it. I think CMG is going under $300, and I think they're going to warn sometime in the next 2.5 months.
All right. S&P's hanging a buck above the low, 59.50. We are down 8 SPU handles. If you're looking for a level under 24.60, then you have an intraday low from Monday at 24.54.50. So that could be a potential target on the downside. It's about another 5 handles from where we're trading.
Couple other stocks here on the list. VRX. What do you think of this chart?
I wish I would have shorted
Look
it.
at consolidation stations.
It is.
Around 1367, 1368. Kramer gave it some love last night on Fast Money. He had the CEO on there, giving it some love. They're saying they're paying down a lot of debt, and they're going to turn this thing around. Obviously, that's what CEO is going to say. But I just look at 4 lows, right? That 1366. That's a bottom to lean on.
Yep, you got it out.
You got it out. Starts trading 1362 or 6160, and it breaches that. Maybe I get out. So if you don't mind risking 50 cents here, there's an out there.
Well, Dennis, technicians have been looking at this stock as well. 831, that was your all-time low in April. 18.25 has been the high of the rebound. You don't have to be a magician to figure out. The 50% retracement comes in at the 1350 area. So buyers have been stepping in ahead of that at 68. You see that, you're not always going to get your price, but definitely I'd even give it, if you're just trying to swing long here at 14, maybe you're out at 1340. But little better here, little better interest, Dennis. I think this was the area when the chat was piling on you for not liking it at 18. You said, hey, maybe I'll get interested at 13.5, 14. Well,
I know I should get interested now.
It's hard.
I always get interested and everybody else isn't. I like doing that. It's a contrarian in me. Sometimes that works. A lot of times it doesn't, but you're out.
You know what? You're a contrarian momentum investor.
I don't even know what I am half the time. Okay, Macy's, John Dodson. I'll tell you, I'm a bear in Macy's. I've been a bear for a long time. He says it might go under $20 today. I think it might go under $20 here too. GE could go under 25. It didn't go under it yesterday. We got a lot of stocks that the trend is not your friend on. Macy's, definitely the trend is not your friend. Every time this gets a little bit of a pop, it finds new sellers. I do believe this is going to be a teeny bopper here, maybe as early as today. So I agree, John. And I also think this is going the way of JCPenney. So if you look at the JCPenney chart at $3, I think Macy's could have a lot more downside. I don't think the dividend is safe. I think Macy's has some major issues.
Man, you guys are really sticking your necks out here. It's trading at 20.03, and you think it's going to go under $20.
Hey, bold calls here on pre-market prep.
Yeah, I mean, I don't know. Psychological level. I mean, there's probably people still trying to wait to get out from the last report. Under 2011. I keep an eye, if I was shorting this thing, which, hard to do in the hole, maybe if it gets up to the close of 2014, a couple other closes, right, above that. But man, oh man, teeny bopper for the stock, probably off the open. Hey, Spencer, did you see what Flack UK, what stock he's asking about in the chat?
There's lots of stocks in the chat, so no.
No, from Flack UK. Look up a little bit.
Oh, okay. Flack UK asking about Herbalife. Well, I'm glad you mentioned that, Fleck. We actually yesterday I recorded a little thing with Ivan Feinseth and Chris Irons of Quote the Raven. It was a little bit of a back and forth debate. I'm going to air that on the show tomorrow. So it's a pretty good bull bear old-fashioned debate about Herbalife, and I know Joel was listening in with me, and it was really good. It was I think you're going to enjoy it. So that'll be on tomorrow's show. Good old-fashioned bull bear.
Is that going to be on at 9:00?
Yep, tomorrow 9, and
Cool.
we'll promote it today, on Benzinga's, Twitter and Facebook, etc., on our site and all that. But keep an eye out for that tomorrow. So
he's a good follow. I follow him on Twitter. There,
yeah.
He's always got some interesting things to say. Outspoken.
Yes.
To say the least.
Yes.
Okay, so
I just want to say Spencer was like a kid in a candy store during that interview. I'd never seen him laugh so hard.
I just couldn't get a
they
word
were going
in.
At it.
I just couldn't get a
were
word
going at
in.
it.
I was trying to keep like the discussion on track, and I couldn't even get a word in. So, but we'll listen to that tomorrow.
okay. I'm going to tell you about the imbalances here. And Alibaba, obviously, big buy imbalance, 115,000 shares. We know it's going to be one of your sources of strength today. GE, 228,000 to sell. I predicted it was going to go to 25 and open 25 yesterday. I was wrong. It couldn't get down there. It opened at 25.12, went down to 25.05. Couldn't quite get there. 228,000 to sell. It's going to try it again here this morning. Seems like there's just an institutional seller every single day. Maybe it was Buffett before, but it's somebody else now because Buffett doesn't own it anymore. Jumping over here to some other ones. Square, SQ has a buy imbalance every day. It does again here this morning, so it's bucking the trend. It's actually trading in the green here this morning. SQ, 91,000 shares to buy. Not sure if there's some analyst talk or something going on there because it was trading up actually pretty significantly this morning. Or is that a playoff Alibaba? No, can't be.
No. Dennis, one thing I just wanted to mention about the GE, when the last big pop that thing had was in a nice big rally? Is when they had the changes in the C-suite. Yep. Remember that?
Yeah.
And it got the pop and went a couple more days. Yep. And then it got to 27. So, on those big news events, if you're not going to actually trade, the event or whatever, keep an eye on the price action because, that was a telltale event. They wanted him all out. They got him out. They got the pop. And you know what? The guy's not going to change things in like 1, 2, or 3 weeks. So, just keeping a note of levels off historic, not historic, but big events for a company is always a good thing to do.
And here, let's go to the ratings land here. We did mention NUE getting the downgrade at KeyBank, but there's quite a few ratings here this morning. And I just want to mention the Evercore note here because they are initiating on like 1 million biotech companies here. And you made the call here, Joel. This is because analysts from Piper moved over there.
Yep. Josh Swimmer, very well-respected analyst on Wall Street. Might even have his PhD, but boy, he covered a lot of stocks there. Spencer, do you have any highlights?
Yeah, it's pretty much all outperform ratings, a couple of in line. So I guess we'll just run down the list and then we'll go to our first guest or our only guest today. But so we got Voyager, VYGR, excuse me, TSRO. I'm sorry. Yeah.
These are all go to all the outperforms.
Okay.
Neutral, we don't care about.
All right. The outperforms. Here we go. VYGR, Voyager, outperform. TBPH, outperform. SH, I'll put these on the chat. SHPG, outperform. RGNX, outperform. Regeneron, outperform. PRTA, outperform. MY, Mary, Yankee, Oscar, Victor, outperform. IONS and INSM are all outperforms there from Evercore.
AbbVie was the big one, ABBV. I know they mentioned that specifically in the head of the note, and this was one of their top picks there on the outperform. And, when you hear outperform, that's a buy rating there at Evercore. I don't believe they have buys, right? They call it outperform?
Yeah, correct.
It's equivalent to their buy. So 23 stocks initiated, I believe, and there's 1, 2, 3, 4, 5, 6, 7, 8. Looks like about 13 of them.
Yeah, a lot of buy ratings there from the Evercore note. So we're going to take for our break, though. We're going to grab our guest today. That's Jeremy Schwartz. He's Director of Research at Wisdom Tree. So we'll be right back with Jeremy. All right, welcome back, everyone, to Ben Zingo's Pre-Market Prep. Spencer Israel here with Joel Conan and Dennis Dick, and we're on the line with Jeremy Schwartz, Director of Research at WisdomTree. Jeremy, calling you from London today. How's it going?
Spencer, Dennis, thanks for having me. It's great.
So let's just start broad market now. We're just about now at the end of earnings season. What is your take on this earnings season? Broadly speaking, and if there are any sectors that jumped out to you.
Yeah, I mean, I think the big story on the year is really how strong earnings have come in after a few years of very disappointing earnings. And I think the actual central piece of this all has really been, a weak dollar environment, which has actually really supported all of our exporter-oriented earnings. There's a big divergence if you look at just U.S. companies with a domestic revenue base, and this also includes small cap companies compared to just large caps generally, which are more international focused. You're seeing large caps outperform small caps by almost 1,000 basis points this year. You're seeing exporters outperform domestic companies by 700-800 basis points this year. And so you're definitely seeing the support for earnings from the global companies, the weak dollar environment. Beyond that, we've been looking for tax reform, and we haven't really seen any benefits from that. That was one of the things that got small caps and the domestic companies going up to the end of last year, and that's sort of all reversed this year, all tied to the dollar, all tied to just nothing happening with tax reform yet. But I think that's the big story as we look forward towards the end of the year into next year. Will the Republicans come together? Will they get anything actually done when it comes to tax changes?
Jeremy, I was looking at your blog. You have a blog on WisdomTree. You also do the Behind the Markets podcast, and your most recent episode was talking about Forex and carry trades and smart hedging. And I want you to kind of explain, at a high level, explain that discussion a little bit for us.
Yeah, I think this has been one of the big areas WisdomTree's focused on for the last 7-8 years was really the role of currency on international portfolios. And the standard conventional wisdom has really comprised investors when they go overseas, they have to sell their dollars and buy, say, the euro so that they could buy European equities. So they have two bets in place. They're long the euro and then they're long the European stocks. And so we've questioned the conventional wisdom of always being long the euro. It's what we call uncompensated risk, that there's no reason to believe the euro will always go up in value. And so then the question comes, should you be taking that risk, or do you have an idea of when you should take that risk? And the discussion we had on the podcast was with one of the academics at Wharton who's really studied currencies. He's done a lot of work on what's called the carry trade, which is a tendency for high interest rate currencies to outperform the low interest rate currencies through that carry, the interest rate differentials earned. And so we sort of go back and forth on, what is the risk, the risk reduction properties of some of the currencies. The yen is really the only currency today, sort of the major currency that has a strong negative correlation where the yen does act as a quote unquote diversifier to the stocks. But you could also say that means that the yen moves in the exact opposite direction of the stocks, and that the only case to be bullish Japan is if the yen is weakening. So we talk about how you're being paid to hedge Europe, Japan, Swiss. You have negative 1% being paid because the Fed is raising rates. These other countries have negative rates. And so you're paid that interest rate differential, that quote unquote carry trade. And so the question is really, so going forward, do you think you should be taking these currencies? You could generally, for a broad international basket, hedge the risk and get lower volatility for the EFA basket. Or, our new model, what Rusinoff, the academic, called smart hedging, was applying what we call a dynamic factor approach. It's a 3-factor model based on carry, valuations, and momentum that will adjust hedge ratios systematically to add exposure to the euro when it's worth taking, hedge the exposure to the euro in the currency factor model. He says it's sort of a weakening currency environment. And that dynamic hedge ratio, hopefully to us, is sort of the future for national equities. We launched a suite of those funds early of last year. It actually was, the single sort of most successful, you could say, ETF in 2016 was DWM. It's our Dynamic International Hedged Equity Fund. And it's really been able to outperform both always hedged and unhedged funds over that almost 18-month period. So it's really hopefully a good way to get international exposure that has this dynamic hedge on top of it.
Speaking of international exposure, I was just looking at your Twitter feed there, and you tweeted out this morning on these valuations in Japan. And some of these actually, I didn't know that they're trading relatively cheap relative to obviously over here where our multiples are significantly higher. You're looking at a PE ratio on a lot of these Japanese companies between 12 and 13.
Yes. So this is representative of our Japan Hedged Equity Index. DXJ is the ETF that represents that index. And so you're exactly right. You get 12 to 13 PEs. The earnings in Japan are actually all-time highs right now. And the yen is not at its all-time lows in the last 15 years. It's sort of strengthened this year, and the earnings are still coming in strong. So it tells you there's some micro corporate margin improvement that's happening in addition to just the weak yen over the last 5 years. It's been generally supportive for earnings. But, where the narrative is U.S. markets are expensive, we're at 20 PEs. The things that I tend to say, you've got to look at earnings yield versus bond yield is one of the key valuation indicators. And so you look at our TIPS yield, the 10-year TIPS yield today, 50 basis points, a little bit less than that. So you have a 5% earnings yield, call it, and a 50 basis points, so a 4.5% quote unquote equity premium of stocks versus bonds. Well, their TIPS yield or their bond yield, their nominal bond is yielding 0. And the Bank of Japan is saying, we will buy every bond you sell us at 0. And so that spread between the U.S. 10-year, which is now 225 on a nominal basis, their 10-year at 0, and then you compare their earnings yield at 8. And, so an 8% equity premium compared to the U.S., where our equity premium is 3. I mean, I think that stock bond model is really favoring Japan. You had a lot of inflows in 2013, 2014 on Abe coming in, changing the direction of the yen. There's been a lot of outflows the last 2 years that people become skeptical. But to me, it is actually one of the strongest valuation stories around the world today.
Well, Japan topped out in the 90s. The Nikkei did it not, and we have never even got back to close to those valuations, have we?
The Nikkei in 1989 was 39,000. The Nikkei today is 19,700. So
here we are, 30 years later.
30 years later, exactly.
and it's cut in half still.
Well, the story there, I mean, it was actually the greatest bubble of all time. So the whole Japanese market sold at 100 times earnings. It had a 50 basis point dividend yield, a 200 price to dividend ratio. So it was basically our tech bubble of 2000 multiplied by 2.5 times. So it was Japan's going to take over the world. And it also shows you just the problems of market cap weighting, by the way. So, you hear a lot about smart beta factor investing. Well, Japan's weight in IFA, which is the biggest international ETF today, Japan's weight in that index was 60% of your developed international index. Today, it's 20%. It's been deflating for 30 years. So, the conventional wisdom is you need an international active manager to outperform the international markets. Well, that's because Japan's been underperforming for 30 years, and all you have to do is underweight Japan. But the situation is changing, and the active managers aren't changing. They don't actually believe the Japan story. So I think, people are resistant to change. I do think Japan is actually a good valuation. But I think if you look at your general active manager out there, they're still disbelievers.
What other countries do you like?
Japan is an interesting one. Yeah, I mean, I think if you go, the other big story this year, emerging markets have come back. It's been, a rough sled for EM going back before last year for the 4 or 5 years. Going into last year, we're very tough. I think, we did a piece, you mentioned the podcast that we do. We did a show with Ritam Desai from Morgan Stanley a few weeks ago. And my blog recap was called Indian Markets to Triple over the next 5 years. And so I think that is one that if you say, what are some of the strategic things going on in India? You have a Prime Minister, Modi, who's doing really, they're leapfrogging technology around the world. They're doing things that, you envy here in the US. Everybody can open a bank account with their fingerprint. They get their medical records with their fingerprint. They're going away from the use of cash to ban corruption. So everything's going to go digital over there. So from a technology perspective, they're doing a lot of things. They're making a lot of tough reforms. But and they're also encouraging domestic savings into the market. So they're sort of 401k moment where they were only investing in Indian bonds before. They're now increasingly allocating to equities, mandated to allocate to equities. And we think that ratio is going to increase. So you have a young population making more money, saving more in equities. And over the next decade, you could see something like 400 billion come into equities. And we think that's going to be one of the positive things for the markets, combined with the whole demographic and economic reform story. So India is one of our favorites. EPI is our ETF. It's got about 10-year history. It launched in 2008 at around a price of 25. Today, it's also around the price of 25. So it's done nothing in 10 years. And so if you think, can it triple over the next 5 years, it's very possible. So I think that's another one that I particularly like today.
Jeremy, what was that ETF you just mentioned?
EPI is our Broad India earnings fund.
Okay, so EPI and then DXJ was the one for Japan. We've been on the line with Jeremy Schwartz, Director of Research at Wisdom Tree. Also, his podcast is the Behind the Markets podcast. Jeremy, thanks so much for joining us today.
I appreciate the conversation. Thank you.
Thanks, Jeremy.
All right.
It's always nice to talk the international exposure there, and because it's something that we focus very much is just on the U.S. market. Sometimes we touch on the Canadian markets, but we rarely really deviate from North America. It's always nice when you can hear. I wasn't aware that Japan's trading with multiples of 12, 13.
No,
that is
me neither. Me neither. I had no idea. Were there any stocks on your list, Dennis, that we missed?
There's always stocks on my list. I put so many on my list here, but there's a few, a couple stocks and something that's setting up interesting. We haven't talked about it for a couple days. We usually talk about is Twitter. It's starting to get a little bit interesting here, just on this whole 16 area. We're trying to come into consolidation station. And I was saying a couple days ago, I think you can get up there and test that 1648. It hasn't got up there yet. It got up to 1636 yesterday. Didn't quite get that high, but it's kind of hanging out here. Now, if it hangs too long, you start to get concerned that it's hanging out for too long. But here's another example of everybody getting too bullish up there at 20. Now it's coming and nobody's talking about it. When everybody's hushed and nobody's talking about it again, that's when I start to get interested. And it's found, it's formed some support here. As long as it stays above the 1567 low, which we set back on August 11th. Maybe you can make a run. I think this could have the 1648 and potentially 17 eventually on the move here too, as long as it stays, and you can even move the stop up a little bit. The last couple of days, the lows have been around 1593, 1596. So if you wanted to, you could say, okay, I'm going to stop out like 1588 or 1585. Give yourself 30 cents of room from the 1616 we're currently at this morning, or actually in the pre-market we're down slightly at 1605. So you don't have to give yourself 20 cents. And, maybe you get a shot. I mean, that's what it's all about. Trading is all just about setups, and it's all about risk management. Whenever you put on a trade, know where your out is, and then you won't get hurt as bad. Sometimes things happen and there's some slippage. But overall, if you can, just set yourself up and put that risk-reward ratio, 2 to 1 or 3 to 1, it makes your odds a lot better. Where people get hurt with trading is when they get stuck in something and then they hold on to it, hoping it comes back. I always say when you're in the hope trade, you're in the hopeless trade, and then you're in trouble. So, always have your out. So right now I'm defining an out for you. If you like this as a setup, if you like Twitter, 1585 would be my out. It starts going down below 1585. I think I'd want to get out of it. Give myself 20 cents here this morning if it's trading at 1605, and looking for, a potential move to 17.
And the street still, by and large, bearish on Twitter as a whole. Most of the analysts, most of the analysts on the street are still have their selling.
Yeah, we're not saying we're in love with it. I'm sticking this in an investment portfolio right now. I'm saying it's set up for a trade here because it's has consolidated a bit. Just same thing as VRX. We were just talking similar setup. You've got a bottom, you've got an out. 1367, 1368. It's been bottoming there multiple times. I mean, it's up here 14 a quarter. You got chased a little bit farther here now because really, if you're buying it here, it's hard, you almost got to give it down to this 1365 area, and then on $14 stock, you're talking almost 5% lower. It's a little more than I like to give it. But the Twitter, that's a little bit nicer setup, I think, just because it hasn't run as far yet. VRX had a pretty good run up yesterday.
I had on my list GPS Gap. Did they report today? Excuse me. Or are they reporting after
They report tonight.
Oh, tonight.
GPS reports tonight. You wonder with Urban Outfitters. So Urban Outfitters blew it away. URBN was trading up, but then it started to leak. And we talked about this on the show yesterday too. Traded and closed below $20. It's leaking here this morning. It's just like these have like eternal sellers, it seems like, in all these stocks. Even when they blow it away, they just come in and they seem to find new sellers again. It's so hard to buy retailers here. I mean, so here's your setup here. If the gap blows it away, it'll rally. But is the rally even going to hold? If it misses, we know what happens. The thing's probably could even test $20. So it's so scary to take this thing long ahead of the report. Even you can say, well, lots baked in. But the gap, I mean, just think about this. It's got a 4% dividend. This is not, a store that's like the future here. They got those old Navy stores they're kind of like, but, they had their run. They had their time. And now it's past their time. I mean, back 2013, 2014, stock was $40, $45. The kids are just wearing different stuff now. And I just think eventually this one's in a whole world of hurt too, unless they can refigure it out. I think eventually this is a teeny bopper stock too.
The lasting image I have in my head of Gap is in the town I grew up in. There was a Gap in the strip mall. It was a really big strip mall. And then by the time I was, old enough, to be high school and even leaving for college, I'd come back and that strip mall was just just dead. The Gap was still there, but everything else was gone, and it was just like this once thriving strip mall that was now just completely obliterated. And the Gap was like the last survivor. And
there's so many strip malls like that now. I mean, you see this in a lot of different places. I mean, and is it Amazon's fault? I don't know. Or is it a change of just consumers, not going to the mall as much as they used to? But, the malls themselves, even, you're seeing empty spots on a lot of them. But the strip malls, you're right. You see these all over the place where these strip malls are vacant. Scary. Yeah. Scary for the people who own the real estate.
What about another one reporting after the note today, and that's AMAT, Applied Materials?
It's been hot. I mean, Applied Materials, really, when you put it in perspective, has been a monster. Let's look at, the chart, and you can say, oh, well, in the last couple of months, it hasn't been that hot. Well, bring up a weekly or bring up a monthly chart on this thing. Back at the beginning of 2016, it was $15. It's now $45. I mean, they have just, we've had a tech burst here in the last year where every tech stock has just blasted off in orbit, even the old school ones. Applied Materials is one that was, obviously been around for a lot of years here. It's had a big run now, and really, this is the kind of stocks they like. So if this thing misses, 42's got some major support down there, which is $2.50 lower. If it beats, it's up at 48 is where the resistance is. So you're kind of in the middle of nowhere here at 44.30. I feel like it all depends on what the numbers are going to be.
Questions now from the chat. A couple stocks being thrown in by Spinner, SPLK, and Workday. I guess let's look at Splunk first.
We had a good day yesterday. Had a nice pop up, and I don't know if they're due to report or if there's something coming up on this, but 60.76, so it went from 58.31, so had a nice pop yesterday. If you like the 2-day move, you think 62. Now, again, the S&P futures are leaking here this morning, so that can weigh on it a bit, but, I'm a fan of the 2-day move. If it does turn around and catch a bid, I think it could see 62. I do see some major resistance up there at 62 on Splunk, though. And then Workday, WDAY had a fantastic day yesterday, closing right up near its highs. It's not its all-time highs because way back in 2014 it got up to $116, but it is near its 52-week highs. Again, this sets up for a 2-day move. If you think this morning's pullback is an opportunity, a stock like this might give you an opportunity to maybe get it $1 or $2 cheaper because the S&Ps are falling back. And maybe it continues to, show some strength. These are the kind of stocks when you set up, when you have a pullback day, always look for the stocks that have been strong. And if those pull back, that's an opportunity. Like if you're coming in here and you're buying a stock like General Electric or buying a stock like Macy's on these pullback days, you get hurt because these stocks just don't have a lot of love. Workday, people are looking to get into that. I mean, they were getting into it yesterday. They're looking for an opportunity. So sometimes you'll see an overall market sell-off give you an opportunity to get into one of these better stocks at a cheaper price. And again, we're talking trading here. We're not talking long-term investing. But WDAY got some love yesterday. So a lot of times, you see some love the second day in a row. That's my 2-day move. S&P's futures pulling back. It sets up that maybe you get a cheap open, and maybe this thing starts to show some life after the open.
And then Splunk reports on the 24th, Workday on the 30th. So upcoming for both of those issues. Looking at the chat, anything jump out to you or Dennis from your list? Anything you wanted to hit on?
Foot Locker, John Dotson, they do report tomorrow as well. FL, we know, has been hit there because, well, it got hit before when Nike was saying they were going to start selling some of their shoes on Amazon, and Foot Locker's like, whoa, we sell Nike shoes. I will say one thing about Foot Locker. It has formed some nice support around 45. It's going to depend on what they say on this earnings report, though. Everybody's going to be watching this one. It could be wild off of the report. So technicals really take a backseat. If it's kind of a wishy-washy report and it starts to sell off a bit, 45 support. If they miss or if they say something bad with the guidance, this breach is 45. Look out below because it could be really ugly. If for whatever reason, they come in and it's pretty good numbers, you probably have overhead supply here, 50-51. So it's hard to come in here and buy it. I'm almost leaning to sell it. If it pops, I'd almost lean towards selling it just because it's been the theme in the retailers. Whenever they come in and they're actually pretty good ones. I mean, Urban had a really big pop yesterday, but it started to leak again too. I mean, these things just they just can't hold on to their gains, and that's concerning. Like the Target was really concerning for me yesterday, even though it came back and it did get back some of it, but that opening bar in the first half an hour when Target opened up on that strong report and gave it all back, I was like, wow, that is an eye opener that they just hate all retailers right now. And buyers did emerge, and it did come back a long ways there, but the sector just is out of favor. And any retail stock right now that gets a pop just seems to get met with more sellers.
I want to look at Fiat Chrysler. Is this thing going to pull a Twitter where every single time there's a buyout rumor, it just pops, but nothing ever happens? Because this has been rumored now for a couple years. We've got 2 China automakers rumored to be in the hunt, but they're both saying they're not. We've had what was it in the past? We've had Volkswagen in the past, GM in the past, but nothing ever materializing for the stock. What do you see now in Fiat Chrysler?
I mean, it's been on an incredible run. You're trying to fill this long-term gap that we had back in 2016 when the stock went from $13.98 all the way down to $7.94. There's like a huge gap in there. So there's a gap up to 14. It's open kind of. One thing, it's gapped up here again. I mean, you are chasing it here. It's had a pretty impressive year. If you just go out to the weeklies, you can see it started the year down around $9. It's up here at $12.78. I mean, you look at your other traditional automakers, they've gone nowhere here. So this one is outperforming. If it comes out and the rumors are all killed, I think FCAU could be a lot lower then. So hard to come in here now. As a trade, it's breaking out. As a trade, momentum's on your side. As a trade, there's room to 14, but you're chasing it a bit.
All right. That's about it for us. I want to wrap up and preview our show tomorrow. So a couple guests, and I mentioned one of them. We will be airing a debate between Chris Irons of Quote the Raven Research and Ivan Feinseth. He is the director of research at Tigris Financial Partners. And Ivan has a buy rating on Herbalife, and Chris Irons most definitely does not. So we're going to be talking, that'll be probably about a 20-25 minute segment at 9. And then we are joined at 8:35 by Ryan Craver to sort of digest for us all the retail earnings, since we're pretty much done with earnings now. We mentioned Foot Locker tomorrow, but I think with the exception of Costco, we've got all the retail earnings in. So Ryan will be on to kind of digest the whole sector with us tomorrow. That's it for us. I do want to remind you folks about the Benzinga FinTech Summit, September 28th in San Francisco. Kevin O'Leary of Shark Tank will be there. A lot of people from the fintech and from the Silicon Valley space will be there as well. To learn more about that, go to bzsummit.com, and also Benzinga Pro is available. We just got desktop alerts in Benzinga Pro this week, so if that is a feature that you want in your research platforms, desktop alerts you can now get. You don't have to be staring at the platform all day. You don't have to have it open. You can just have it on in the background. Get alerts whenever there is news about any of your stocks that you're following. So to get a free 2-week trial of Benzinga Pro, go to pro.benzinga.com. You can also email me, premarket@benzinga.com, and I will get you hooked up with a trial and potentially a demo if that's up your alley. So that's it for us. Have a good rest of your day, folks. We'll be back with you tomorrow for Ryan Craver and a good old-fashioned debate on Herbalife. Have a good rest of your day.